We're finally not a broken record anymore. This has actually happened for time in 7 years. So what's the latest domino to fall after that Bank of Canada decision?
The expected domino, and that is the chartered banks have started to raise their prime rates, which is their benchmark, their guide for what they charge us for some types of loans, and sometimes guides them in terms of what they pay us for savings. But in the last few minutes, here is the news from RBC. The prime rate at RBC goes to 2.95%. That's up 25 basis points. So effective tomorrow, rates that float with prime, things like variable rate mortgages, lines of credit, will go up by 25 basis points. And because all banks tend to follow each other, we can expect the other banks to also make their announcements through the day. Now, this chart is showing us what the Bank of Canada did this morning. Its key overnight rate, that yellow circle you see there, goes up. And that is the first increase. You'd have to go back to 2010, September of 2010, to have found the last time the bank raised rates. Really, though, if you saw that very flat line through the last 7 years, rates are still ultra low. And a lot of people, weren't expecting this until about a month ago when the Bank of Canada governor and the deputy governor began to change the message. And they were asked today, why? Why did things change between a very cautious April messaging to this rate hike today in July? And here's the answer from Carolyn Wilkins, the deputy governor.
We've had a couple of more labor force survey data that show the labor market's doing very well. We've seen at the same time some export data more recently that have been encouraging, and some monthly GDP data that show that broadening is not only occurring across demand categories but also across sectors.
And so that is why the Bank of Canada, after not seeing, the first quarter results yet, looked at the first quarter results, then looked at these new pieces of data and decided it's time to raise interest rates.
This is a tough question. What does this mean for Canadians? And I guess it all depends on your circumstance, right? So
Yes.
it's a tough question to answer, but generally speaking.
Well, I mentioned variable rate mortgages and lines of credit. So let's look at an example here. These will go up immediately tomorrow. And an example of a $500,000 variable rate mortgage, it amortized over 25 years, it's going to mean about $80 more a month that goes to interest. So if you already have a payment, you tend to keep the payment, but less of your money goes towards principal, more of it goes to interest. Home equity line of credit. The average amount that people have on their home lines would be about $70,000. So the interest portion goes up by $13.42 a month. But notice this is after one rate hike. If there are more, you can multiply that by the number of times this rates will go up. As for that, we wanted to hear from the Bank of Canada governor. Will he be raising rates again, and when? Here's the answer.
Of course, interest rates are still very low. People need to understand that in the full course of time, I don't doubt that interest rates will move higher, but there's no predetermined path in mind at this stage.
Now, one impact of higher interest rates is that the dollar tends to go higher, and boy, has it ever, Andrew, up about 1.25 cents against the U.S. dollar, 78.63 cents U.S. We haven't seen this in more than a year. So, and that's the one argument against raising rates, because the dollar will go higher, and that'll hurt exports, which could hurt growth. That's why the timing of this is very important, very delicate.